Hi folks, welcome back to another episode of Investment Income for Life. Today we need to talk about Bitcoin. No hype, no overnight millionaire promises. Just the cold, hard reality of what it looks like to buy the dips in a major crypto correction. If you've been watching the charts, you know Bitcoin has taken a beating from its previous highs. And yes, I practice what I preach. I've been actively averaging down my Bitcoin purchases. I started buying in at the peak of 100,000 US dollars plus, kept buying as it fell, and my latest buy orders hit at 63,000 US dollars. When you blend all those purchases together, my current average sitting price is exactly 72,000 US dollars. Now, looking at your portfolio in the red is never comfortable, but here is exactly why I'm not panicking. Why am I comfortable buying at these levels? It all comes down to the mechanics of the Bitcoin halving. Historically, Bitcoin moves in predictable 4-year cycles tied to its halving events, where the reward given to miners is cut in half, reducing the supply of new coins. If we look back at historical data, a pattern emerges. The absolute market bottom typically forms roughly 25 to 30 months after a halving. Following our last halving back in April 2024, that exact historical window places our current market cycle bottom right between May and October of 2026. We are standing right in that data window right now. The massive 40% plus correction we've experienced from the peak isn't a structural failure. Historically speaking, it's a textbook bottoming process. The daily supply of new Bitcoin entering the market has dried up, and while institutional ETF flows and macro data cause short-term noise, the structural supply floor is firmly setting in. But let's pause the optimism for a second and get real. Bitcoin is highly volatile. It is an asset class that can drop 15% in a single weekend because of a geopolitical headline, and then shoot up 20% the next week on global liquidity shifts. Because of that insane volatility, you must not overinvest. If you put a massive chunk of your net worth into crypto, you are exposing yourself to severe concentration risk. When a single asset dictates whether you can pay your bills or sleep at night, you've crossed the line into gambling. Bitcoin shouldn't be the foundation of your retirement fund. It should be a calculated, controlled satellite allocation. To put my money where my mouth is regarding asset allocation, my entire personal investment in Bitcoin is only around 4,000 Singapore dollars. For my portfolio, that is an amount I am completely comfortable letting ride through the macro waves. If it drops further, my lifestyle doesn't change. If the halving cycle plays out like history suggests it will, it's a fantastic asymmetric upside. As always on this channel, our goal is building sustainable investment income for life. We don't risk the farm on highly volatile plays. We allocate carefully, manage risk ruthlessly, and use data to guide our entries. What's your current Bitcoin average price? Let me know in the comments below. Don't forget to hit like, subscribe, and I'll see you in the next episode.